Did you know you can transfer or gift mutual fund units between Demat accounts? Today, we'll walk you through the process, key steps, and tax implications so you can do it smoothly, whether for family or friends. Transferring mutual fund units between Demat accounts allows you to move investments between your own accounts or even gift them to loved ones. However, this process is offline and can be a bit cumbersome. Currently, the only way to gift mutual fund units is by holding them in Demat form. So let's go over how this transfer process works and how to navigate it. To start, both the transferor and the transferee need active Demat accounts. If your units are held in physical form or as statement of account (SOA), they need to be converted into Demat format first. Here's a step-by-step guide for dematerializing your mutual fund units. Number 1, fill out a dematerialization form. This form is available from your depository participant (DP) or broker and requires details like the mutual fund name, folio number, and units to be dematerialized. Number 2, submit and wait for processing. Once submitted, the conversion takes about 3 to 4 business days, after which the units appear in your Demat account. This conversion is necessary because only Demat units can be transferred between accounts. So make sure your units are in Demat form before moving to the next step. To initiate the transfer, the transferor must fill out a delivery instruction slip or DIS, which you can get from your broker or DP. Key details required: ISIN number, the unique identifier for the mutual fund units found on your account statement. Transferor's details, the DP ID and BO ID, the DP ID and the client ID of your Demat account. Transferee's details, the DP ID and BO ID, which is the DP ID and client ID of the recipient's Demat account or your own Demat account if you're self-transferring. Quantity or number of units to transfer. Both in numbers and words, you have to write a reason for transfer, such as family gift or gift between personal accounts, your own. Must ensure that the mutual fund units in your folio should be free, that is, they should not be under lock. For example, in the ELSS scheme or retirement fund or children's fund, they are locked. Be sure to avoid any overwriting on the DIS form. If a correction is necessary, the form needs a counter signature next to the change. Once completed, submit the DIS slip to your broker's office in person or by courier. You may need to include a client master report or CMR for verification. For transfers valued above Rs 5 lakh, additional verification like a video call might be required. Once verified, the transfer typically completes within 1 to 2 business days, although some brokers may experience logistical delays. Factors like mailing delays or form rejections can extend the process to a few weeks or even months in some cases. Logistical delays may occur while couriering the physical DIS slip to your broker, but once received by the broker, the transfer should take only a day or 2 business days. Transferring units from one Demat to another comes with a cost. Typically, there's a 0.03% transaction fee or Rs 25, whichever is higher, plus 18% GST. Additionally, a stamp duty of 0.015% applies to all such transfers. For larger transfers, these fees can add up. Tax implications for family versus non-family transfers. Now, within the family, gifts to specified relatives, such as defined by the Income Tax Act, are exempt from income tax regardless of the amount. However, when the recipient eventually sells the gifted mutual fund units, they will be liable for capital gains tax based on the capital gains realized compared to the original cost of acquisition. To non-family members, if the gift's units value exceeds Rs 50,000 in a financial year, the recipient will be taxed on the entire value received. Similar to family transfers, the recipient will be liable to also pay capital gains tax when they eventually sell the gifted mutual fund units. Proper documentation, including a gift deed, is essential to ensure accuracy during future audits. If you find the Demat format too restrictive, you can rematerialize units to convert them back to SOA form. This involves filling out a rematerialization request form or RRF and submitting it to your broker or DP, who forwards it to the AMC or RDF for processing. Once complete, your mutual fund units return to SOA, which allows for more flexibility to transact on multiple platforms and bypasses broker limitations. Further, in case of any change in nominee, bank details, address, this shall be done through your DP only, unlike in SOA where you are required to send separate requests to the RTA for all AMCs. Rematerialization also saves you from annual demat account charges and other broker costs. So it may be preferable if you plan to manage your investments independently. Holding mutual funds in demat form limits your ability to transact on platforms other than your brokers, potentially increasing transaction costs and limiting access to certain features. By contrast, SOA format allows transactions on free platforms like MF Utilities, MF Central, and the AMC websites. Holding units in SOA form provides more freedom and can reduce transaction costs. While transferring mutual fund units through demat accounts offers the ability to gift investments and consolidate holdings, the offline process can be slow and expensive. For flexibility and ease, many investors prefer the SOA format. Make sure to consider the costs and tax implications before initiating a transfer and explore rematerializing if you are looking for more freedom in managing your investments. Thanks for watching. If you found this guide helpful, give us a thumbs up and subscribe for more insight.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.